Okay, so let's dive into something really fascinating happening in the market right now. You've got two groups of investors, regular folks on Main Street, and then you have the so-called smart money, the big hedge funds. And right now, they're on the complete opposite sides of a massive trade involving 10 of the most powerful companies on the planet. Main Street is selling, while Wall Street is very quietly buying them up.
And that, right there, is the big question we're tackling in this explainer. We're talking about 10 huge household name companies that have just had a rough year. They've disappointed people. So retail investors are looking at this and heading for the exits. But the institutions, they see a golden opportunity and are buying more. So who's right? Let's break it all down.
All right, just a quick but super important heads up before we get started. Everything we're about to talk about is for informational and educational purposes only. This is not financial advice, so please always do your own homework and talk to a professional. To really get what's going on, first, we have to understand the psychology. We need to look inside the minds of these two very, very different types of investors. It really all boils down to one powerful emotion: fear. That's what creates this huge split. When a stock starts to drop and the headlines turn ugly, retail sentiment just tanks. And the natural reaction? It's to sell and get away from the pain. But hedge funds, they see these temporary narrative problems as a window of opportunity. It's their chance to buy a world-class company before it gets its groove back. This right here is the conflict in a nutshell. So where exactly is this battle playing out? Well, let's get to the evidence. We're going to count down the 10 companies at the heart of this divide, and we're starting right now. Kicking us off at number 10 is the healthcare behemoth UnitedHealth Group. Now, Main Street is looking at the here and now. Medical costs are going up, and there's a lot of uncertainty around payments. It's scary stuff. But the hedge fund vision, they're playing chess, not checkers. This is a classic move for them: buy a dominant, sprawling healthcare empire when everyone else thinks the good times are over for good. Next up, at number 9, we have Salesforce. You know, for years, this company was an unstoppable rocket ship. But now that it's maturing, Main Street is kind of feeling like the magic is gone. The institutions, though, they see a completely different picture. They see an incredibly profitable company that leads its category, spits out tons of cash, and has huge potential with AI. For them, a little less growth just means they get to buy it at a better price. Coming in at number 8 is Intuitive Surgical, the company behind the Da Vinci surgery robots. Now, when the market gets nervous, you know how it is. Investors get real picky and they refuse to pay a high price for any stock. That's the fear for Main Street. But the hedge funds, they love this exact scenario. It lets them take advantage of that shrinking price tag to own a truly elite business with fantastic recurring revenue, often right before growth is expected to pick back up. At number 7, we've got Danaher. The whole life sciences industry has been in a slump. And frankly, retail investors are just tired. They're done waiting for a turnaround. There's just fatigue. But Wall Street sees a picks and shovels business, a company that provides the essential tools for the whole industry, and they are snapping it up at what they think is the bottom. Because by the time the recovery is obvious to everybody else, the stock will have already made its move. And rounding out the first half of our list at number 6 is Visa. The fear here, it's simple: boredom. The stock isn't the new shiny thing anymore, so retail investors have moved on to chase the next big trend. The hedge fund vision, though, isn't about excitement. It's about security. It's about owning a durable cash printing machine that just keeps benefiting from the slow, steady death of cash around the world. All right, we've made it through the first 5. Now let's see how this whole dynamic plays out with the top half of our list. And trust me, these are some of the most well-known companies on the entire planet. At number 5 is Thermo Fisher Scientific, another huge player in that life sciences space. And just like with Danaher, the retail fear is pure impatience. Investors are just tired of waiting for demand to come back. But the big institutions, they see this company as critical infrastructure for all of healthcare innovation. They know the business is solid and that sooner or later, the sentiment is going to turn. Number 4 is Mastercard. And much like its rival Visa, the story is all about attention. The market always wants more surprise, more growth, more speed. Hedge funds, on the other hand, are choosing durability over hype. They see a chance to buy a premium global payments company, which is still growing, by the way, without having to chase the stock price way up. Now, for a number 3 company, the divide is captured perfectly by this visual. For Main Street, it's just a messy, tangled-up story. For the hedge funds, it's about looking past all that mess to find the diamonds hidden underneath. And that company, of course, is Disney. Retail investors are just exhausted by all the drama, the losses in streaming, the questions about ESPN's future, the hit-or-miss movies. It's just too complicated. But the institutions are looking right through all that noise.
What they see is an incredibly powerful and profitable parks business and a library of intellectual property that is basically impossible to replicate. Our runner-up at number 2 is Amazon. The fear here is all about spending. Main Street sees these huge, eye-popping investments in data centers and AI and gets really nervous about profits in the short term. But hedge funds are looking at the massive potential return on that spending. They're buying in to make sure they own the winner of the next great wave of computing and to protect the long-term dominance of Amazon Web Services.
And the number one stock that Main Street is selling while hedge funds are buying is Apple. The fear out there is real. You hear it all the time. Where's the next big thing? What is their AI strategy? But the smart money sees something completely different. They see the ultimate fortress business, a company that relies on an unbreakable ecosystem, incredible brand loyalty, and just elite levels of cash generation, even when the narrative cools off.
So now that we've walked through all 10 examples, let's just zoom out and summarize the core idea here. What is it that actually triggers the buy or sell decision for each of these groups? This slide just lays it out perfectly. Main Street reacts to pain. The triggers are falling prices, ugly-looking charts, and scary headlines in the news. Wall Street, on the other hand, reacts to moats, a company's deep, durable competitive advantage. Their triggers are things like market leadership, a resilient business, and the belief that today's fear creates a long-term opportunity.
You know, this whole thing really boils down to one final crucial takeaway. It's a complete shift in mindset. And here it is. This is the absolute heart of the whole thing. Main Street sells what feels bad. It's an emotional reaction to what's happening right now. Hedge funds buy what still matters. It's a rational decision based on the underlying long-term value of the business. It's the ultimate battle between feeling and fundamentals. So the key here is to just reframe the question. You got to stop asking why everyone is panicking and selling. Instead, look closer and ask, what does the smart money see that I don't? Because like we've seen, these aren't just random broken companies. They are dominant, world-class franchises that are just working through some temporary bumps in their story. And that leaves us with one final question for you to think about. When you look at an investment, what are you reacting to? Is it the short-term, temporary pain that everybody is feeling, or is it the long-term, permanent power of the business itself? The answer to that question might just define everything.